Welcome back to the channel, Future Financial Pros. Today, we're diving deep into a specific stock that's lit up our hard-to-borrow screener, and it's not one you hear about every day. We're talking about Clearmind Medicine Inc., ticker symbol CMND. This isn't just about general market theory, we're breaking down exactly why CMND is appearing on our radar right now, using real numbers and specific data. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show CMND logo and chart. So let's talk about CMND, or Clearmind Medicine Inc. This is a clinical stage pharmaceutical company operating in the healthcare and biotechnology sector. Their mission? Developing novel psychedelic medicines to treat some seriously underserved health problems, including alcohol use disorders, binge drinking, eating disorders, weight loss, obesity, and metabolic syndrome. They're tackling big challenges with innovative approaches. CMND currently has a modest market cap of just $3.01 million. Looking at recent price action, CMND saw a minus 1.43% change today. Over the last 5 days, it's down minus 12.29%, and over the last 30 days, it's dipped minus 16.53%. Today's volume was particularly low at 55,600 shares, which is Xerox's 30-day average volume of 3,622,576 shares. What is cost to borrow and why it matters? Before we get further into CMND, let's quickly define what cost to borrow or CTB is for those just starting out. When you short a stock, you're borrowing shares you don't own, selling them, and hoping to buy them back later at a lower price to profit from the difference. But borrowing isn't free. You pay a fee similar to interest on a loan, and that's the cost to borrow. This fee is typically expressed as an annualized percentage. Why does it matter? Because a high CTB indicates strong demand from short sellers and limited supply of shares available to borrow. When the fee climbs significantly, it means short sellers are paying a premium to maintain their positions, signaling high conviction, or, more interestingly for us, potential stress in the short market. Why this stock is hard to borrow right now. Highlight CTB number. Now this is where CMND gets interesting. Our screener flagged Clearmind Medicine Inc. because its cost to borrow fee is currently an astronomical 555.2% annualized. Think about that, a short seller would theoretically pay over 5.5 times the stock's value per year just to hold their position. That's a seriously high price to pay. We've also seen the CTB momentum decrease by minus 13 percentage points over the last 5 trading days, indicating some slight easing, but it's still extremely elevated. What's more, there are only about 40,000 shares currently available to borrow for CMND, against an estimated float of just 1.5 million shares. When there are very few shares left to borrow and the fee is sky high, it means short sellers are finding it incredibly difficult and expensive to establish new short positions or even to maintain existing ones. Our internal composite squeeze score for CMND, which combines CTB level, momentum, borrower supply, float, and technicals, currently sits at 41.7 out of 100. This score suggests there are some key ingredients for a potential squeeze present. Squeeze mechanics explained. So, what is a short squeeze? It's when a stock's price surges upwards, forcing short sellers who bet against it to buy back shares to limit their losses. This buying action further pushes the price up, creating a feedback loop that squeezes more short sellers out of their positions. When a stock like CMND has a very small supply of shares available to borrow, and the cost to borrow is so high, it amplifies this effect. If positive news or increased buying pressure enters the market for CMND, short sellers could be caught in a difficult spot, needing to cover their positions but finding few shares available, driving the price even higher in a rapid fashion. It's important to remember, though, that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock will eventually decline, and they are willing to pay a premium to maintain that bet. Dilution risk check. Show screenshot of SEC filings. One of the most significant risks that can negate a short squeeze thesis, especially in microcap stocks like CMND, is dilution. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can depress the stock price by reducing the value of each existing share. This can essentially create an out for short sellers, as new shares become available for them to cover their positions, or it can simply provide new supply that negates buying pressure. For CMND, I check found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days, which is a positive sign for short squeeze potential, and it reduces this particular headwind. Recent reverse split watch. Highlight reverse split date. Now, something else to note for CMND is its recent reverse stock split. ClearMind Medicine Inc. executed a 1-4-10 reverse stock split on May 21, 2026. This was 49 days ago, just over a month past that typical window. A reverse split reduces the number of shares outstanding and proportionally increases the share price. For example, if you own 10 shares at $1 each, after a 1-4-10 split, you'd own 1 share at $10. While reverse splits often carry a negative stigma, many microcap stocks historically tend to see renewed volatility or even a price pop within about a month after a reverse split, as the share price is reset and the float is reduced. While this is a common pattern observed in some microcap names, it is by no means a guarantee, and CMND is slightly past that initial post-split volatility window. Again, a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For CMND, if you're watching this stock, you'll want to keep a very close eye on several key indicators. First, changes in that incredible cost to borrow fee. Any sustained drop could indicate short sellers are covering without a squeeze, or that more shares have become available. Second, watch the shares available to borrow. If that 40,000 number dwindles further, it could signal increasing pressure. And crucially, keep an eye on volume. As we saw, today's volume was exceptionally low for CMND. A sudden, significant surge in buying volume, especially on positive news or strong technical breakouts, would be a strong indicator that a squeeze could be developing. Show CMND chart again. So, there you have it, ClearMind Medicine Inc., CMND, a healthcare biotech play with an exceptionally high cost to borrow, a very low supply of borrowable shares, and a relatively small float. It's a textbook setup for a hard-to-borrow stock, but always remember the risks involved and that high CTB doesn't equal a guaranteed squeeze. Understanding these mechanics is vital for anyone interested in the complex world of short interest and potential squeeze plays. If you found this deep dive into CMND insightful, make sure to like this video, subscribe to the channel for more unique stock breakdowns, and let us know in the comments what other hard-to-borrow stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next one.